Hi, welcome back. Today I want to do something a little different. I want to take you back to the year 1940 and show you exactly what one single dollar could buy back then. Then I want to bring you right back to today, 2026, and show you what that same dollar can buy now. And once you see the difference side by side, I think it's going to change the way you look at money for the rest of your life. Because this isn't just a history lesson. This is really the story of what happens to your savings, your paycheck, and your future when you leave your wealth sitting in something that quietly loses value every single year without you even noticing. Let's set the scene. In 1940, $1 could buy you a full meal at a diner, a movie ticket with change left over, or about 3 gallons of gasoline. A loaf of bread cost around 8 cents. A dozen eggs cost about 33 cents. The average home in America cost around $3,000. Now think about it this way. If you had a $100 bill in your pocket in 1940, you basically felt rich. You could pay rent, buy groceries for weeks, and still have money left over. Now fast forward to today. $100 barely covers a grocery run for a small family. It might not even fill up a truck with gas. So the question everyone should be asking is simple. What actually happened? Did the dollar change? Did it get weaker somehow? And if so, why did that happen? And where did all that value go? Here's what this means in the simplest terms possible. The dollar itself didn't physically change. The paper is still paper. But the purchasing power behind that paper, meaning how much stuff it can actually buy, has shrunk dramatically over the decades. Economists have a name for this. They call it inflation. And inflation, in the most basic sense, means that prices rise over time, which really means the value of your money is falling over time. If you had taken a single dollar in 1940 and simply kept it in a drawer, doing nothing with it, not spending it, not investing it, just holding on to it, that same dollar today would only be worth a tiny fraction of what it used to be able to buy. Some economists estimate that a 1940 dollar has lost somewhere around 95% of its original purchasing power by today. Let that sink in for a moment. 95%. That means if you had $100 back then, in terms of real buying power, it would feel more like having about $5 today. Now this is important because most people don't actually think about their money this way. We look at the number on our paycheck, we look at the number in our bank account, but we rarely stop to ask what that number can actually do for us and how that has changed over time. A dollar is not a fixed thing. It is more like a shrinking balloon. It looks the same size on paper, but the air inside it, meaning its real value, keeps slowly leaking out year after year. So why does this happen? Why does money lose value over time instead of staying the same? Let's break this down step by step. Modern money, the kind we use today, is called fiat currency. That simply means it has value because a government says it does, and because people trust and accept it. It is not backed by gold or silver or any physical asset sitting in a vault somewhere. It can be printed, created, and expanded whenever a government or central bank decides more of it is needed. And when more money enters the economy, but the actual amount of goods and services doesn't grow at the same pace, prices naturally start climbing. More dollars chasing the same amount of bread, eggs, and homes means each individual dollar becomes a little less special, a little less powerful. This wasn't always the case, though. Go back further, before 1971, and the United States dollar was actually connected to gold. This system is often referred to as the gold standard. Under that system, the government couldn't just print unlimited amounts of currency, because in theory every dollar in circulation was tied to a certain amount of gold held by the country. This created a kind of built-in discipline. Money supply couldn't expand endlessly because it was anchored to something physical and limited. In 1971, that connection was removed, and the dollar became a fully fiat currency, free to expand based on economic and political decisions rather than being tied to a fixed physical resource. Now, I'm not here to tell you this decision was good or bad. Economists still debate that today, and there are reasonable arguments on both sides. But what we can observe simply by looking at historical data is that the pace of dollar devaluation noticeably increased after that shift happened. Now here's where the story gets really interesting and where silver enters the picture. Unlike paper currency, silver is a physical, tangible metal. It cannot be printed. It cannot be created out of thin air by a policy decision. It has to be mined out of the ground, refined, and produced through real physical effort and real physical limits. Because of that, silver has held a very different relationship with value throughout history compared to paper money. Let's go back to 1940 again, but this time let's talk about silver instead of paper dollars. Back then, silver was actually used inside American coins. Dimes, quarters, and half dollars were made with actual silver content, not the copper-nickel blend we use in coins today. So in a very real sense, holding a silver coin back then meant holding a small piece of physical metal, not just a printed promise. Now here's the powerful part. If you had taken the silver contained inside just $1 worth of coins in 1940 and held on to that physical silver instead of paper dollars, and then converted it back into today's dollars based on the current price of silver, that silver would be worth significantly more than the paper dollar equivalent. In many comparisons, that same amount of silver would today be worth somewhere between 20 and 30 times more than the paper dollar was originally worth. Think about that difference for a moment. The paper dollar lost around 95% of its power, but the physical silver inside those old coins didn't just hold its value, it actually multiplied it many times over. Now this is important, and I want to be very clear here. This does not mean silver is magic or that it always goes up in a straight line every single year. Silver prices do move up and down. There are periods where silver goes sideways for years. There are periods of sharp corrections. Nobody should treat any asset, including silver, as a guaranteed one-way path to wealth. But what history does show us pretty clearly is a pattern. Over long stretches of time, physical assets like silver and gold have tended to preserve purchasing power in a way that paper currency simply has not been able to do, mainly because paper currency can be expanded without physical limit, while silver cannot. Let's use a simple comparison to make this even clearer. Imagine two different people in 1940. One person decides to keep $100 in cash sealed in an envelope and just holds onto it for decades without touching it. The other person takes that same $100 and converts it into physical silver at the time. Now imagine both of them open their envelope or their safe today in 2026. The person holding paper cash would find that their $100 can now buy only a small fraction of what it used to buy: groceries, gas, rent. All of it would feel almost impossible to cover with that amount. But the person holding the equivalent value in physical silver would find something very different. Because silver is priced based on today's market value, not the old 1940s price, their holding would have grown dramatically in dollar terms, and their real-world purchasing power would be far closer to what it originally was, in some comparisons, even higher. This is the core idea I want you to walk away with today. Paper money is a promise. It represents trust in a system, in a government, and in economic stability. Physical metals like silver represent something else entirely. They represent a real physical limited resource that exists independently of any government's decision to print more currency. That difference, trust-based value versus physical scarcity-based value, is really the heart of why these two forms of money have behaved so differently over the last 80-plus years. Before we go further, if this kind of breakdown is helping things click for you, go ahead and hit that subscribe button and give this video a like. It genuinely helps this channel keep making these deep dive breakdowns, and it costs you nothing. All right, let's keep going. Now let's talk about why this matters for you personally, right now, in 2026, and not just as a historical curiosity. Inflation is not something that only happened in the past. It's still happening today. Prices for groceries, housing, insurance, and everyday goods have all been climbing noticeably over the past several years. Many working families have felt their paychecks stretch less and less, even when their income technically went up. That feeling where you're earning more but somehow affording less is a very real and very common experience of currency losing purchasing power in real time. Now I want to be balanced here because there are different perspectives worth mentioning. Some economists argue that moderate inflation is actually a normal and even healthy part of a growing economy, encouraging spending and investment rather than hoarding cash. Others argue that persistent long-term currency devaluation quietly punishes savers, especially those on fixed incomes, like retirees living off pensions or savings accounts. Both of these viewpoints have real merit, and this isn't a simple black and white issue. The goal here isn't to tell you what to believe, but to give you the historical context so you can form your own informed opinion. Here's a simple mental framework that might help you think about this going forward. Instead of only asking, "How many dollars do I have?" try also asking, "What can these dollars actually do for me, both today and in the future?" Money isn't really about the number itself. It's about what that number can be exchanged for in real goods, real services, and real quality of life. When you start thinking in terms of purchasing power rather than just raw numbers, the entire picture of saving, spending, and planning for the future starts to look a little different. Looking ahead, nobody can predict the future with certainty, and anyone who claims otherwise should be viewed with healthy skepticism. Inflation could slow down in the coming years. It could also continue at a steady pace or even accelerate depending on economic policy, global events, and countless other variables that are impossible to fully forecast. What we can say, based purely on historical patterns stretching back decades, is that paper currency has consistently lost value over long periods of time, while physical assets like silver have historically served as one of several tools people have used to help preserve purchasing power across generations. This is simply an observation from history, not a prediction or a guarantee about what will happen next. Connecting this back to real life, think about your own long-term goals for a moment. Maybe you're saving for retirement, maybe you're setting money aside for your children's future, or building an emergency fund, or simply trying to grow your family's financial security over time. Understanding how inflation has historically eroded paper currency and how physical assets have historically behaved differently gives you an important piece of the puzzle when you're thinking about how to structure your own financial decisions. This isn't about making any specific move today, it's about understanding the forces at play so that whatever decisions you do make, you're making them with clear eyes and real historical context rather than guessing in the dark. It also helps to remember that this pattern isn't unique to the United States or to the dollar specifically. Throughout history, many different currencies around the world have gone through similar cycles of gradual devaluation. Governments and central banks, regardless of country, generally have the ability to expand their money supply when they feel it's necessary, whether that's to respond to a crisis, stimulate economic growth, or manage debt. And each time that happens, the existing currency already in circulation tends to lose a small piece of its relative value because there's simply more of it competing for the same amount of real-world goods and resources. This isn't a conspiracy or a hidden secret. It's actually a well-documented and openly discussed part of how modern monetary systems function, and economists across the political spectrum acknowledge it happens, even if they disagree about whether it's ultimately good or bad for society. So let's bring this all together. In 1940, a single dollar could buy a full meal, several gallons of gas, or a dozen eggs with change to spare. Today, that same paper dollar buys only a small fraction of those things, having lost around 95% of its original purchasing power. Meanwhile, the physical silver that used to sit inside American coins back then has, in many comparisons, not only kept pace with the passage of time, but significantly outpaced the decline of the paper dollar, in some cases being worth 20 to 30 times more in real purchasing terms today. This isn't magic, and it isn't a guarantee for the future. It's simply what happens when you compare a currency that can be printed without limit against a physical metal that cannot. At the end of the day, this story isn't really about silver or gold or any single asset. It's about understanding how money actually works, how value can quietly erode over time, even when the number in your bank account looks the same or even grows, and how history can give us useful context as we think about protecting the things we've worked so hard to build. I hope this breakdown gave you a clearer picture of just how much things have changed since 1940 and why so many people continue to study these patterns today. Thank you for watching all the way through. If you found this valuable, don't forget to like, subscribe, and share it with someone who might find this eye-opening too. I'll see you in the next one.